Housing market activity is crashing, and it threatens to push the U.S. into recession just like it did in 1981 and 2008. The go-to line this year from analysts and economists alike is that the Fed will push until something breaks. Increasingly, it's looking like that something might be the weakening U.S. housing market. Las Vegas is one of the leading indicators for home price action in the housing market. Like we saw in 2008 and the recent frenzy, we are absolutely feeling the heat here. The buyer pool has, for the most part, dried up. Kristen Rifle, a real estate agent in Las Vegas, tells Fortune. But it's not just bubbly markets like Las Vegas and Boise that are feeling the pain. The housing downturn is picking up steam nationwide. In fact, as of last week, mortgage purchase applications are down 38% on a year-over-year basis. That marks the lowest reading since 2014. Simply put, housing activity is crashing. The crash in housing activity, or as Fed Chair Jerome Powell calls it, a difficult correction, didn't appear out of thin air. It's by design. The Federal Reserve flipped into inflation-fighting mode this spring with hopes that elevated interest rates would cause activity to slump in rate-sensitive sectors like housing. The Fed's reasoning for slowing the housing market boils down to two words: demand destruction. Historically speaking, mortgage rates spike as soon as central banks go into inflation-fighting mode. That mortgage shock causes sales for both existing and new homes to fall. As builders cut back, demand for both commodities like lumber and durable goods like refrigerators then declines. It also causes real estate and construction layoffs. Those economic contractions then quickly spread throughout the rest of the economy and, in theory, help to weaken the labor market and tame high inflation. The most frequent way we enter into a recession is the Fed raising rates to fight inflation. The leading indicator for this type of recession is housing. Bill McBride, author of economics blog Calculated Risk, told Fortune, housing is not the target, but it is essentially the target. We're already seeing these housing economic contractions. Home builders are cutting back, real estate firms are trimming headcounts, and some regional housing markets like Boise and Seattle have already slipped into a home price correction. Realtors are feeling it big time as well. I put in a call to the Greater Las Vegas Association of Realtors, and the employee I spoke with said that they were averaging about 300 new members every month. This month, she had estimated 120. However, she has been processing about 30 realtor withdrawals a day. That means every day around 30 real estate agents in Las Vegas alone are calling it quits. Heading forward, economists and analysts alike believe the housing market will continue to deteriorate. This year, Wells Fargo projects sharp declines in new home sales, existing home sales, and housing GDP. Then, in 2023, Wells Fargo expects another drop in new home sales, existing home sales, and housing GDP. While the housing downturn appears to be on a trajectory that could push the U.S. economy into recession, nothing is certain. If inflation eases, the Fed could pivot policy before a recession becomes locked in. If Wells Fargo's forecast, which also predicts a 5.5% decline in U.S. home prices in 23, comes to fruition, it would mean that the housing market downturn reaches a level that historically occurs only during recession. There's also the theory that a significant drop in residential investment, which makes up 4.6% of GDP, wouldn't be as impactful on today's less housing-dependent economy. There's also the theory that a significant drop in residential investment, which makes up 4.6% of GDP, wouldn't be as impactful on today's less housing-dependent economy. While it's true that private investment topped out at a much higher share of GDP in 2005 at 6.7%, we're actually slightly above the share seen in 81, which was 4.4%. So take that to mean what you think it might mean.